Dr. Eckles earned a Ph.D. from the Wharton School at the University of Pennsylvania. He has published articles in top insurance journals, has acted as a reviewer for several peer-reviewed journals, and has been named the Distinguished Reviewer by the Journal of Insurance Issues. David, we're pleased to have you here today.
Thanks, Marty. Today we will conclude the Insurance Fundamentals for Policyholders webinar with the fourth session, that is a discussion of regulation and legislation and how it affects insurance products and insurance markets. In particular, we're going to address several issues such as the National Association of Insurance Commissioners, the activities of state regulators, including state-run insurance programs, market conduct regulation, solvency regulation, product regulation, both rate and form regulation, as well as insurer and agent licensing requirements. We'll then conclude our discussion with webinar with a small discussion surrounding insurance fraud. Before we talk about any of this, let's look at what we sort of refer to as an umbrella organization, that is the National Association of Insurance Commissioners, or the NAIC. The NAIC is sort of a compilation of insurance commissioners across the United States, and because insurance is regulated at the state level, the NAIC doesn't actually have any real official regulatory power, but it does operate as an office to help coordinate activities across the states. And to that end, the NAIC encourages states to cooperate with each other when it comes to licensing, product regulations, and so on. It will also take a more proactive approach in offering what they refer to as model laws or model regulations. You can sort of think of these model laws and model regulations as sort of a template, so that not every state has to go out and create the rules and regulations themselves. Rather, they get these sort of templates from the NAIC. And if indeed many states use these model laws and regulations as the basis for their own state-specific rules. So they may not use the model law verbatim, but rather will add to it with their own specific rules that they want to adhere to. All right, Marty, why don't you ask them a question? Let me be quiet for a second.
Sure. And this is some food for thought, and we invite the attendees to submit their thoughts via the Q&A if they want to share. What do you think? Do you have examples of NAIC model laws or regulations adopted by the states? And David, I'll turn it back to you for your thoughts while people have an opportunity to put some input into the Q&A section.
Sure, and I'll also say to that end, if you have questions during the whole webinar, feel free to put them in the Q&A, and again, Marty and I will try to get to as many as we can. But here, for the specific question, of course the answer is going to vary and depend on the state you're in, but NAIC model laws are in fact found and adopted all over the country. A recent example of this would be sort of the health information privacy laws that we've seen that help try to manage who can know what about insureds when it comes to health insurance, as well as from the doctor's perspective. All right, now let us turn our attention to the activities of state regulators. Indeed, the state regulators do enforce laws, regulations that insurers licensed in the states must abide by, so that's their general goal. But before we address some of those issues specifically, let's take a moment to consider another question that Marty will have for you.
And here's another point for discussion. What do you think? What regulatory activities typically involve an insurance regulator?
And indeed, we're going to discuss a lot of these. So as you're listening, hopefully you'll have thought of some of these issues that regulators will do. And in fact, there's actually really no shortage of issues that state insurance departments handle, and that includes the handful of activities that you're going to see on these next two slides. Now, you'll forgive me for for sort of scrolling through these very quickly, but we're going to discuss each of these in more detail as we go on today. But at the end of the day, all of these things sort of are there for the regulator to help the regulator ensure that insurers are operating in good faith with respect to their customers where it comes to pricing or the policies that they offer. They're there to make sure that insurers are solvent, that is, that they're not going to go bankrupt, and ultimately, I like to think of the regulator as being there to provide a general confidence in the insurance market, so that the customers, the consumers know that when they buy a policy, it's a good policy, it's going to cover what they think it's going to cover, and of course, most importantly, it's going to provide coverage for the claim if a claim does occur. The primary regulator in each state is often called the insurance commissioner. This commissioner can be either elected or appointed by the governor. This certainly varies by each state. To that end, whether we have an appointment or an election, the experience of the commissioner will also vary across the state. That being said, most insurance commissioners will have some sort of background in the insurance industry, though, again, as the case with elected officials in particular, that's not always the case, nor does it necessarily have to be the case. In addition to sort of general oversight, and again, we'll talk about many of these details later on today, many states also provide actual insurance to the residents and businesses in the state. And we're going to take a few moments to take a look at some of those state-provided insurance products. This is sort of a list of the ones we'll talk about. Among others, states have state-run workers' compensation plans. They offer unemployment insurance. They will often offer automobile liability insurance, as well as other property insurance. This is typically some sort of homeowners type policies. These are either sort of general, which is sort of the fair access to insurance requirements, or the FAIR plans, or can be peril specific, such as a windstorm plan, or if you're in Florida, a sinkhole plan. Oftentimes the states will provide coverage for these specific perils. But let's look at these in a little bit more detail. When it comes to workers' compensation insurance, for the most part, workers' compensation is provided as would any other insurance be provided, and that is by the private market. There are a handful of states, however, that do not allow any private market workers' compensation insurers to operate in the state. And in fact, in these cases, the state operates what is referred to as a monopolistic fund. For your information, the 4 states that do this currently are Ohio, North Dakota, Washington, and Wyoming. And here, in these 4 states, you can only get workers' compensation insurance through this state-run insurance plan. Alternatively, some states operate what they refer to as a competitive fund, which, as the name suggests, competes with the private market providers of insurance. So that is, you have both the private market providers as well as the state-run workers' compensation plan. And lastly, and we'll see this later on, particularly when it comes to auto liability and homeowners insurance, many states operate what we refer to as a residual market for workers' compensation insurance. And this is a market where those businesses, in this case, that cannot find workers' compensation insurance, can go to the state, and the state will provide the insurance for them. Residual markets are rather important, particularly when it comes to regulation, because this is a place where, again, in this case, businesses that can't find insurance for coverage can't find insurance coverage, in the private market can turn to the state for coverage. And this is important because the state regulates and requires that businesses provide some sort of workers' compensation insurance or coverage. And that's also true for other insurance, in particular auto liability. So where the state has required that someone purchase the insurance, sort of they feel it necessary to be the sort of what we might call an insurer of last resort, so that if you can't find the insurance in the private market, the state will provide the coverage here. And that's what a residual market is, and that is indeed what we see with workers' compensation. We do see states operating these residual markets. Unemployment insurance is another type of insurance that states often offer. This is a bit unique in that there's essentially no private market alternative to unemployment insurance. So no private insurers offer unemployment insurance that you can just go out and buy as an individual. And to that end, every state operates an unemployment insurance fund. There are federal statutes that sort of set minimum standards for the unemployment insurance, but the operation of these funds does vary quite a bit across the state. That is, the benefit, how much one can get when they're unemployed, how long can they get that benefit, how is it renewed, as well as how are companies taxed to fund this program. These issues all vary fairly significantly across the states. And these actually have been a casualty of the recent Great Recession, as they call it. And in fact, many states have suffered fairly significant losses in their unemployment insurance plans, perhaps probably not too surprisingly. We've alluded to automobile insurance plans earlier, but this is again another example where states operate residual markets. Again, because the states require automobile liability insurance, they also act, again, as we call this, the insurer of last resort for those individuals that cannot find the insurance in the private market. Here, we're typically thinking of high-risk drivers, so those that have had a lot of accidents, a lot of tickets, find sort of the standard private market insurance either unaffordable or that it's not available to them, period. And the operation of these plans does vary by state. Most states do not actually supply the insurance themselves, as we saw with workers' compensation. Rather, what happens here is states create what they refer to as an assigned risk plan or an assigned risk pool. And what they'll do is they'll require that the insurance companies that are operating in the states take on the risk of a certain number of policies or certain number of these high-risk drivers. So the state will assign those high-risk drivers to participants in the state. And if the insurance company wants to sell the sort of the standard insurance, they have to participate in this market. Sort of by definition, these are very expensive for the insurance company to provide. So to that end, the states sort of spread the wealth, so to speak. So not one insurance company has to take them all on. They spread them out. Another type of insurance policy that the states provide or covers that states provide that for individuals are property, other property insurance plans, and this is typically we think of these as homeowners plans. Again, the FAIR plans, this refers to what they call the Fair Access to Insurance requirements, and this is another example of residual market. Here we're thinking of homeowners that have to have insurance for their mortgage or for some other lending requirement and simply can't find it in the private market. The little difference here in the property versus the auto is that the high risk comes from sort of just something the policyholder has no control over, such as they live in a high hazard area for fire, for wind, etc. And they may find it, in fact, very hard to find insurance, and these FAIR plans do provide insurance to those individuals. Specifically for wind, you have what are sometimes referred to as a beachfront plan. These are that they've called beachfront plans or Windstorm plans or Windstorm pools, and it's what their name suggests. They're there to cover homes in particular, but property more generally from the peril of wind. Not surprisingly, you find these mostly in states with significant coastal exposure. As an example, Florida has a very large residual market for homeowners insurance, and their residual insurer, Citizens, actually began some time ago as a wind pool. That's how it started, wind and sinkholes, actually. All right, and lastly, states operate what we refer to as a guarantee fund. You can sort of think of this as sort of an insurance against bankruptcy. And so what these plans do is that they are used by policyholders who, when they have a claim, find their insurers to be insolvent. And so you go to the insurance company, make a claim, and they no longer exist or they can't pay the claim. The state guarantee fund will kick in. Though these funds typically do not pay the full claim amounts. So you're more likely to get 60-70% of the claim, but at least you get something, whereas you would technically be able to get nothing if your insurance company was insolvent. As with other plans, this is funded by the insurers in the state, though sort of in a different way. Either every insurer every year pays a tax to go towards this guarantee fund, or in the event of an insolvency, the surviving insurers will pay a tax to help cover the claims generated by the bankrupt insurer. All right. At this point, we'll let Marty ask you a question and give a chance to break from me for a little bit.
Thanks, David. We've arrived at the first of our two polls today. And before we read the poll question, a reminder to our attendees that we welcome your input and questions in the Q&A section. You technically can send us a question through the chat, but there's a chance we might not see it. So there's two dialogue areas. The Q&A section would be the first choice for that. So having said that, we'll turn to our poll question, and you'll have 30 seconds to record your answer. Which of these are examples of state government insurance plans? Options include A, unemployment insurance, B, automobile insurance, C, flood insurance, and D, workers' compensation insurance. And I see that the poll has closed, and the results are we have several votes for A, unemployment insurance. We've got one for C, flood, and a few for workers' compensation, D. So, David, perhaps you can discuss the results of the poll.
Yeah, this is a bit of a trick question, actually. So technically, A, B, and D are all correct answers. So as we've mentioned today, states certainly offer unemployment insurance plans. They do offer automobile insurance plans, whether it's actually insurance or through the residual market, and they certainly do offer workers' compensation insurance. C, we had a couple people pick C, and they'll, I don't want to beat you up too much for that, because indeed this is a government-provided insurance, flood insurance, but typically that's done by at the federal level by the National Flood Insurance Program. So I'll give you credit, a little bit of credit for C anyway, because although it's not state-provided, it is a government-provided insurance plan. All right. Well, let's move on and think about generally what we're going to refer to market conduct and solvency regulation. So not only do state regulators provide some of the insurance that we discussed earlier, regulators also manage the activities of the private insurers operating in the state. In particular, regulators govern the sales, underwriting, and claims handling processes used by the insurers. This is generally what we refer to as sort of market conduct regulation. In addition to this market conduct regulation, regulators also monitor the solvency, that is the financial stability of insurers. But first we'll examine these market conduct issues. As we mentioned a moment ago, when we say market conduct, we're typically referring to sales issues, underwriting issues, and claims handling processes of the insurers. When it comes to sales and underwriting issues, states monitor agents and brokers, so this is sort of on the sales side, to try to minimize any sort of fraudulent practices such as embezzlement of premiums. On the underwriting side, states monitor the insurers themselves in an attempt to prevent any unfair underwriting practices such as discrimination, unfair cancellation of policies, poor payment of claims, these sorts of things. And we'll note that agents or insurers that are found guilty of these practices do run the risk of having their license suspended or revoked. States also monitor insurer claims handling processes. In particular, and we sort of alluded to this a little bit earlier, states attempt to ensure that the insurers are offering timely claim payments, that they're not denying any legitimate claims, they're not offering low settlements, they're not misrepresenting the policy provisions. And to that end, to the extent that claims agents or agents themselves are sort of misrepresent themselves, they can be fined or again have their license revoked or suspended. Another important role of the regulators is to monitor insurer solvency. That is, what we mean by that is the state wants to make sure that the insurers are financially capable, financially secure enough in order to pay claims when they come due in the future. And indeed, insurance is a little bit unique relative to other sort of businesses in that we buy a product today and we don't know if we're going to be able to use that product, if we're going to have to use the product, nor do we necessarily know when we're going to use that product. So, for instance, we might, if we're a company, we might buy a liability policy for products liability, for instance, and we may never have a claim, or if we have a claim, it might come due 10 years, 20 years in the future. On the individual side, life insurance is a similar way. Unfortunately, we know we'll always use it, but we don't know when that's going to happen. So in that way, insurance is unique in that we may or may not ever use the product, and we don't know when that's going to be. And so to that end, the insurer solvency is a fairly significant issue. All right, Marty?
Okay, another point of discussion, food for thought. Welcome everyone's input. What do you think? How do regulators verify that insurers are solvent? If you've got thoughts on that or questions on that, please put them in the Q&A section. And now back to David.
And if you're just taking some mental notes and mentally answering the question, well, let's just see if you're right. We're going to discuss the answer to this question here. Broadly, there's basically sort of a four-step recipe for monitoring insurance solvency, and we're going to discuss each of these steps, setting financial requirements, conducting field examinations, etc., here in more detail. So the first thing a regulator typically does is set some sort of minimum financial requirement. That is, they might set a minimum level of capital, a minimum reserve requirement. They might say you can't grow so fast, these sorts of things. These are, again, designed to sort of be the minimum acceptable levels of a solvent, a good insurer. And while these requirements are applied consistently to the insurers within the lines of each state, the requirements can vary across the different types of insurance, and they certainly vary across the state. Once the regulator has set the financial requirements, they sort of monitor that those requirements are being met. One way to monitor those requirements is by conducting on-site, or what they might call field examinations of insurers. Depending on, of course, the size of the insurance department, the size of the state, these are done more or less often. But ultimately what we're looking at here is sort of an in-depth examination, literally on-site audit to determine that to ensure that the insurance companies are operating correctly, that they're maintaining sufficient capital levels, et cetera. Of course, in between those field examinations, regulators can use annual financial statements that are submitted by the insurers to try to access some solvency information. The NAIC, as we discussed earlier, not only operates and provides sort of general rules and regulations, but they also have a generic insurance financial statement that insurers typically follow. And these statements, these statutory statements, are submitted to the state. The data that is included in these statements is very broad and very detailed. So it gives not only information from the basic assets and liability side, but it also gives information on premiums written in each state, the reserving, et cetera. So there's a lot of information, and in fact, with all the information, the regulator has quite a bit of information to help assess the insurer's financial strength. One of those bits of information, or sort of, I guess we should say a set of that information, is what is typically referred to as the IRIS ratios. IRIS stands for the Insurance Regulatory Information System. And what the IRIS ratios are is essentially what they refer to as an early warning system that was designed by the NAIC to help with the early detection of insurers with potential solvency issues. So depending on the line of insurance, it's between 11 and 13 financial ratios with certain prescribed acceptable ranges prescribed by the NAIC. And the idea is that if we look at these ratios and we look at where a company falls within the ranges, the more ratios that are outside of those sort of acceptable ranges, the more likely it is for an insurer to become insolvent. So regulators often use these IRIS ratios as again, they call it sort of this early warning system. Though I will mention that the IRIS ratios are one way to assess solvency issues. There are other tools. One can look at the risk-based capital of an insurer, as well as the NAIC has another tool called the Financial Analysis Solvency Tool, or the FAST, F-A-S-T scores, to provide information with respect to insurer solvency. If an insurer is deemed to be insolvent, the regulators have several options, one of which is to try to rehabilitate the insurer. The way this is usually handled is the state will appoint some sort of oversight committee or some other insurer to try to get the insurance company back sort of on good standing. The state could actually take over the insurer itself and handle operations themselves. The state could dissolve the insurer. When this is done, what typically happens is it takes the policies that have been written and assigns them to the surviving insurers. And you can think of this again as sort of like those assigned risk pools we mentioned earlier. Or sort of a worst case scenario, the state can completely liquidate the company and sort of void all the contracts that have been written. Well, in addition to this market conduct and solvency regulation, states also regulate the rates, and what we mean by rates is sort of the prices that insurers charge, as well as the forms, that is the sort of the policy terms that insurers can use. So before we talk about rate regulation, let's again make sure what we're talking about here is the sort of the unit price of the insurance. So we all might have a different sized house or We might want different liability coverages for our car. And so we might have different premiums, but at the end of the day, the rates charged the price should be reflective of the risk. And so I might have a certain risk, someone else may have a different risk. Those rates may be different, but at the end of the day, the idea is to regulate that rate, that price that they're charging, the risk price. And again, we can all buy different amounts of insurance for our different exposures. But the idea behind the rate is that they are the sort of risk-based part of the insurance. And the regulation comes in so that the rate is adequate. So we might think of, first of all, that the regulators want to make sure the rates aren't too expensive, that they're affordable, but indeed they also have to make sure that the rates are adequate enough to cover the claims. And if they're not adequate enough to cover claims, if rates are too low, then in fact the insurer may have a solvency problem and that they don't have enough money to cover claims. They also, as you may originally think, do provide coverage for or regulate that the prices aren't too high. That is, they do not make what is often referred to as an excessive profit. So insurers, of course, are allowed to make some profit, but the profit is not too much as defined by the regulator. And lastly, of course, that these rates are not unfairly discriminatory. That is that if I have the same rate as someone else, the same risk as someone else, we're charged the same price regardless of anything else. The types of rate regulation are shown here, and in fact they are listed from sort of the most strict type of regulation to the least strict. Some states essentially set the insurance rates for the insurers in the state, and this is of course referred to as mandatory rate regulation. Prior approval refers to the situation where the regulator first must approve of the rate before they can be used by the insurer. File and use states. In these states, insurers have to file their rates with the regulator, but they can use the rates until, unless they are ultimately not approved. Use and file states are similar, except the insurer can use the new rate before they file them. And I understand we're splitting a few hairs here. The difference really is only in the timing. So the file and use, you technically have to file them before you can use them. The use and file, you can use the rates before you file them. Again, not a very big difference. A relatively new form of rate regulation is referred to as the flex rating. And what this does is it allows insurers to change the rates, and they don't need to seek approval unless the change meets some sort of threshold as set by the state. So if the rate is going to change by 10 or 15%, whatever the state says, if it's below that threshold, there's no need to seek approval. But if it's above that threshold, they must seek approval. And then finally, open competition laws require that there be no approval by the regulators for the rates set by insurers. And in fact, here what the state is allowing is for the competitive market forces to discipline the rates. And so you set whatever it is, the insurance companies set whatever rates they want, the competitive forces, sort of discipline this idea. And the regulator will only step in when they observe what they believe to be an egregiously unfair rate. In addition to these rates, the prices, states also regulate the content of the insurance policies. In particular, states want to ensure that the policies are clear and do not contain any unfair provisions. Oftentimes, states require that specific provisions. A good example would be a cancellation provision, where states oftentimes vary on how long they allow the insurer to have the right to cancel, how long the insured has the right to cancel, these sorts of things. So they require that these sorts of things be included in the policies. States also have readability standards that apply to insurance contracts. However, we should be very clear here that the goal is for what they refer to as a fair and readable contract. However, the regulator is not trying to impose some sort of uniform policy across insurers. And indeed, we see on commercials all the time, insurers have their own forms, their own coverages, and they compete on these things. And these, oftentimes differ significantly across insurers. The goal of the form regulation is to sort of meet some sort of minimum standards with respect to the provisions and the readability. We'll also point out that most of the regulation that we've mentioned up to now is meant to protect small and individual purchasers of insurance. And so, again, the idea is to protect you and I from sort of the big bad insurance companies, so to speak. And so to that end, you don't see a whole lot of regulations that apply to what is often referred to as, quote-unquote, sophisticated purchasers of insurance. And those, again, sophisticated purchasers of insurance are those that are accessing the surplus lines markets. You might recall those. We discussed those in our previous sessions. If you don't, we're going to discuss them actually a little bit in a minute. Also, commercial purchasers of insurance. They're thought to be sort of know their risk. Perhaps they have a broker that helps them with their risk, as well as anyone that is sort of buying a unique, hard-to-place risk. This might be an aviation or some sort of ocean marine type insurance, these sorts of things. The idea is that anyone buying this insurance knows what they're doing and doesn't need this sort of protection. All right, we have another poll for you, Marty.
Thanks, David. And as with our past poll, we hope everyone will participate in answering this. There will be 30 seconds to record your response. The question is, which one of the following best explains why states typically regulate policy forms? Option A, to ensure that all insurers use the same forms. B, to prevent unfair competition by insurers. C, to prevent unfair policy provisions. Or D, to ensure that insurers charge adequate rates. And our poll has ended, and here was what the results look like. We have some of our attendees have selected C, to prevent unfair policy provisions. And we do not have any answers for A, B, or D. David, back to you to discuss the results.
Yeah, so we got, I think, 100% here, that there are some tricky answers there. Some of those answers are things that reasons insurers may regulate rate. So, for instance, D is certainly reasons that insurers states regulate rates. But yes, C, to prevent unfair policy provisions, is sort of the right answer here for this question. So very good to everyone, 100%. All right. Moving on top of the rate and form regulations that we've discussed, states also require that for insurance companies to operate in what we'll call the standard market and to sell products in their state, the insurer must be licensed in that state. And of course, they also require that individuals, including agents, brokers, oftentimes agents, brokers, and claims professionals, be licensed as well. And we're going to talk about this licensing here briefly. So the first thing to note is that there are generally three types of insurers in the standard market, and I keep saying standard. I'll talk about the difference between that and the non-standard in a moment. These three are domestic insurers. Domestic insurers are those that are both incorporated and licensed in the state. Foreign insurers are those that are licensed in the states but are incorporated elsewhere, in particular in another state. And an alien insurer are those that are licensed in the state but incorporated outside of the United States. So we're seeing more and more foreign companies come in. They can still be licensed in the states, but are they incorporated outside the United States? These insurers are also generally characterized by one of three types of ownership forms. Stock insurers, as you may guess, are those that are owned by the shareholders or the stockholders. We should note that when we talk about insurance companies, most stock insurers are not publicly traded. They're typically privately held stock insurers. These are sort of managed in sort of a typical structure with the board of directors, ultimately with the ultimate oversight. Mutual insurers are somewhat unique to the insurance industry, and here the ownership of the corporation is actually the company is actually owned by policyholders. So State Farm is a very famous mutual insurer, and when you buy a policy from State Farm, or at least their mutual company, they have a lot of them, you actually are an owner of State Farm. So you're not only a policyholder, but you're an owner. To the outside world, and if you didn't know that you're an owner, you wouldn't be able to tell a difference. Again, they're managed by and sort of the same function, by the same sort of board of directors up top. The only difference is that the board of directors are elected by the policyholders and not the shareholders, the stockholders, which would be the case in a stock company. And then finally, reciprocal insurance exchanges are similar to mutuals in that they are owned by their policyholders. Here they oftentimes call them subscribers. They're not used a whole lot, though farmers that we see the commercials for all the time, they're actually a very large exchange insurer. So there are not a whole lot of these that still exist, but farmers is a big one. We alluded to this notion of a standard market earlier, and promised I would tell you what we meant by that. If you recall from our previous session, the one that I did anyway, we mentioned the surplus lines market. And if you remember, we mentioned that surplus lines insurers offer what we called then non-standard policies. That is, they covered some sort of unusual risk and are indeed not licensed in the state. And indeed, we have more specifically what we're going to call these insurers now are non-admitted insurers. And again, these are like surplus lines insurers. They're not licensed in the state. We're going to talk about what that means here some more in a second. Every other insurer is what they call sort of a standard market, would be what we call an admitted insurer. So those surplus lines companies are not admitted and they're not licensed. It doesn't mean they can't operate in the state. And in fact, as we mentioned before, we do see a fairly significant surplus lines market. That said, they're not allowed to sell products that the standard market would sell. So that is, the surplus line market is not going to sell your basic automobile liability or homeowner's policy. Rather, they're going to sell insurance for some unusual risk, and this might be for a zoo or something like this. And further, to access these markets, these surplus lines markets, you usually have to use a surplus lines broker or producer, and these brokers and producers have to be licensed with a surplus lines license. So that sort of is a nice segue to other licensing of individuals. So we've mentioned that insurance companies have to be licensed, have to be sort of allowed to operate in the state, but the state also requires many individuals working for the insurers to be licensed. So agents, brokers, claims professionals, all of these usually require a license in the state. Though states do vary in their licensing requirements. Most states call for some sort of an exam or a test when the license is issued, and then some kind of ongoing continuing education requirement for renewal. Okay, Marty, why don't you ask him a question?
We will. Right before we get to that, though, a question came in earlier, and it ties into your last slide, so maybe we'll take a chance to field that now.
Sure.
There was an inquiry regarding the NAIC role in agent licensing and continuing education requirements. Is that something you can speak to?
Yeah, so much like sort of the general discussion we had earlier, the NAIC has really no say. So they cannot require states to do this, that, or the other when it comes to anything, including licensing. However, they can offer sort of a model test or something like this that that states can utilize as sort of the basis for their licensing exam or renewal process.
Okay.
Does that answer the question?
It does for me, and I hope it does for our audience. And we'll move on to our food for thought question here. What do you think? What is the purpose of licensing individual insurance professionals, such as producers and claim representatives? And once again, we invite our attendees to, you can just think about this privately, but certainly if you want to share some feedback or questions, use the Q&A dialog box on the right-hand side of your screen.
And I will say that as with the theory of a lot of this regulation, I think the general answer here can be thought of as sort of a consumer protection idea. That is, the goal is to make sure that the agent or the claim representative can have some sort of minimum education, some sort of minimum knowledge that can help the consumer, whether if they're buying the policy for the agents or when they have when they have claims as for the claims professionals. All right, and then lastly, we're going to turn to a brief discussion of insurance fraud. The following statistics were provided by the National Insurance Crime Bureau and the Insurance Information Institute, and as you can see, and they're probably not surprised by, insurance fraud is pretty big business. And in fact, second to tax evasion is sort of the costliest white-collar crime in the states. And indeed, about 10%, when we just think about the property casualty side of things, about 10% of their losses and expenses are attributed to insurance fraud. And to put that in perspective, that's almost a little bit more than $30 billion per year. If we want to think of that more of an individual level, you can think of your annual premiums for sort of a combined homeowners and auto, and a lot of this is in auto. You pay about somewhere between, on average, $400 to $700 more per year only because of fraud. All right, Marty, last question for him.
Once again, food for thought for our attendees. What do you think? Name some forms of insurance fraud, and this should be an easy one.
Yeah, and indeed, I'm sure many of you will have thought over time of some of the issues that we're going to discuss. And in fact, again, you've probably thought of it. Maybe you know someone who's done some of these things. But sort of the obvious idea is that you just lie about a claim. So you make a false claim. Say you had a loss when you didn't. But not only lying about the existence of a claim, but exaggerating claims is also a big issue. They often refer to this as padding of claims. And so this happens when you claim that you had more stolen out of your house than you actually did, or that the dent that was already in your car, you claim that happened in your most recent wreck, these sorts of things. Trying to get the repair shop to increase it to cover your deductible. All these things would be considered an exaggerated or padded claim and do constitute fraud. But we'll also note that not only are these claims-related issues fraudulent, but also any sort of false or intentional misrepresentation on an insurance application can be considered fraudulent. This is oftentimes done for lower rates. So saying you're in better health than you are, or you don't smoke, these sorts of things can constitute fraud. Of course, the best case scenario is if you're caught, you just have your policy revoked. Worst case, we'll talk about here in a second. The good news of all this, not to end on such a bummer note, well, the good news is that in a relatively recent study by the Insurance Research Council shows that attitudes towards fraud are improving. So that said, you still see, roughly 1 in 5 or 1 in 4 individuals still thinking it's okay to pad a claim, whether it's to make up for a premium or make up for the deductible. Though these are sort of off the peak of roughly 2 out of 5 or 40% in the mid to late 90s. And this study also showed that, not surprisingly, fraud attitudes do vary by age and gender, with younger men typically having the worst attitude. And as I alluded to earlier, this fraudulent activities are illegal, and sort of the best case is that your policy is revoked or your claim isn't paid. Worst case, you can be prosecuted. The Violent Crime Control and Law Enforcement Act of 1994 specifically talks about insurance and makes it illegal, particularly when we talk about interstate commerce. But the other two laws there on your slide, the Federal Mail Fraud Statute and the RICO Act, you probably heard about in the past with respect to other issues, and in fact are used to prosecute fraud. So if you mail in an application to insurance that is fraudulent, you may not know it, but you just essentially committed mail fraud and can be prosecuted. In addition to these sort of to the federal laws, there are also, of course, state laws for insurance fraud. States also have fraud laws when it comes to reporting fraudulent activity, and in fact, they have laws as to who has to report them, whether it be a healthcare provider or agent, something like this. And they also have that so-called whistleblower statutes that provide some immunity to those that do indeed report some fraudulent activity. All right, well, that wraps up our session for today. We've covered a lot of information, including various state regulatory tools, how they regulate rates, the policies themselves, the market conduct regulation, how they deal with insolvent or almost insolvent insurers, as well as the licensing of the insurers, as well as the individuals working for insurers, including sort of a wrap-up of discussing insurance fraud issues. So now, thanks again for being part of the seminar, and I'm going to turn it to Marty to officially conclude.
Well, thanks, David. And we do have a couple of minutes left, and maybe we'll have an opportunity to answer a question or two. There's an inquiry, what might be a good way or a best way for public policymakers to educate homeowners, especially those in coastal areas, about choosing coverages that they might need from homeowner policies, flood policies, beachfront, or windstorm plans?
Yeah, that's an excellent and timely question, and the answer to that is hard to answer. And I know that might sound like a cop-out, but that's certainly going to vary as to where the policyholder is, and it's also going to vary as to what's available for the policyholder. So in Florida, for instance, there is a private market for homeowners insurance, but there's also this relatively large residual market, and the state provides insurance to this what they call citizens provider. And so, whether these individuals are educated through their agents, if they're educated when they buy a home, a lot of companies, a lot of mortgages require homeowners insurance. In these particular areas, they not only require homeowners insurance, but they also require flood insurance. The NFIP has access to flood maps, so that you can see if your home is in a floodplain. So where this comes from, where that education comes from, I think is a very difficult question, and it depends on sort of the, who is at risk. So if the regulator has money and can, have an educational program, that's great. Oftentimes, the insurance companies themselves, of course, have an incentive to educate their customers so that they can earn more premiums. The states may have, outside the regulator, may have an incentive because if they don't, they're going to be on the hook for flood-related losses that they oftentimes pay, and Florida is a good example here, particularly if there's a state-run insurance company. So I think that's a long way to answer the question, which it comes from everyone. So the insurance companies, the regulator's office, as well as the state in general, should be attempting to educate these consumers, particularly those that are in sort of a high risk or high hazard area, which you do see a lot of around in coastal areas.
Okay, well, terrific. That is a thorough answer, and we are now just about out of time. So Dr. Eckles, thanks for joining us today and sharing your expertise with our audience. Thanks also to all of you who attended this session. We appreciate your participation in our soft launch. Within a few days, you will be receiving an email message from us with a link to a post-event survey. Please remember that we need your feedback. This is your opportunity to help shape the development of these new delivery options. Thanks again for joining us. This concludes today's session.